Hi everyone, and welcome to ACCA P4. The objective of this presentation is to debrief the LSBF ACCA P4 Advanced Financial Management Revision Mock for June 2014. So let's quickly go to the question, and I explain the key areas that you have to pay particular attention in solving that question. So question number 1 is a 50-marker question, and it's compulsory for you to answer. So let's go straight to the requirement. Requirement A reads, using the above data, prepare a report advising the managers of Dayton which, if any, of the 3 alternatives to adapt. Include in your report comment on any weaknesses, limitations of your data analysis, relevant calculations, including estimate of the present value of future cash flows from existing operations and the estimated adjusted present value of diversifying into the hotel industry. Okay, should form part of appendices to your report. So when you read this question, what are the key things you would have to be looking out for? The question is saying, using the above information, you would have to advise the management. You are advising the management. You are advising the management on which of the 3 alternative policies they should adopt. As part of your discussion, you also have to talk about the limitations of the analysis that you have made, and as part of the appendices, you would have to include present value of the future cash flows from existing operations, and then also to calculate the adjusted present value if they have to diversify into the hotel industry. So this is the question A. The whole scenario of the question is that this company is thinking of either selling the existing business, or they are considering of continuing with the existing business. And should they continue with the existing business, they are also intending to go and buy a hotel business. And as such, the question is testing your understanding of if we have to consider whether we would have to sell an existing business, or we would have to consider whether we would have to continue with the existing operations. The simple common sense here is that the company is there to maximize the shareholders' wealth. So if we decide to sell the company's existing operations, how much money are we going to give to the shareholders? If we decide also to continue, what will be the value of the company to the shareholders? So there will be the need for us to compare the proceed or the net proceed from the sale of the existing business to the present value of the future cash flows if the company decides to continue, which will be the value of the company if the company decides to what? Continue. So when you go to the solution, we have indicated it to you that your first responsibility is to recommend as to whether they should sell the company or they would have to what? Continue the operations. You need to compare the value when sold to the value when we continue. And as such, the company is being sold. If we decide to sell it, we can sell it for an amount of 20 million. According to the question, we can sell to a competitor for 20 million. If we can sell to a competitor for 20 million, how much premium are we getting? If you look at the question told you that currently the company shares is trading at a price of 92 cents. And given the current balance sheet or statement of financial position, you will see that the company is having how many shares? The number of shares will be 5 divided by 0.25, and that is giving you the 5 divided by 0.25 is giving you 20 million shares. Given a market price of 92 cents, if I multiply by 92 cents, how much market value am I going to get? I'm getting a market value of 18.4 million. So given that the company could be sold for an amount of 20 million, then we are going to sell it at a premium of the difference between the 20 million and the current market world price. So if you go to the solution, that's why we said you are going to get a premium of 8.7%, which is basically the 20 million minus the 18.4, which is 1.6 divided by the 18.4 multiplied by the 100%, and that is what is giving you 8.7. So if we have to sell, this is the premium we will give to our shareholders. Is it good? Whether it's good or not, we would have to compare it with what will be the value if we decide to continue the operations. And the question gave us two scenarios, that if we decide to continue the operations, then it depends on whether political party A or political party B wins the election. And the question gave us the cash flows, telling us that if political party A wins the election, then this will be the future cash flows up to 2019. If political party B wins the election, this will be the cash flows up to 2019. But the cash flows will also what? Increase beyond that, or will stay beyond 2014. So let's see what we're supposed to do. So if the company continues, the value will depend on whether the political party A wins or political party B wins the election. So we have to find the present value of the cash flows if political party A wins, and the PV of the cash flows, because the market value should be the present value of the cash flows, isn't it? So let's find the present value of the cash flows. So if we go to the solution, that is what we did in here. That is what we did in here for you. So all about you calculating the present value of the cash flows. So to calculate the present value of the cash flows, if political party A wins, these are the sales figures. We are picking the cash flows given to us from the question. So you pick up to 2019, and then the question told you that from 2019 onwards, after 5 years, the cash flow will stay constant at 2019 figure. So 2020 to 2024, the cash flow will stay constant at 2019 figures, with the exception of the fact that the question also emphasized that working capital will end in 2019, and capital allowances or tax allowable depreciation will also end in 2019. So between 2020 to 2024, there's no going to be any capital allowances and working capital. When you get the net cash flows over the period when political party A wins, what then will be the discount factor? Okay, cost of capital wasn't given to us, so we would have to go and calculate the WACC of